Heather, we're at 8:32. Do you want to kick us off?
Yeah, I think I'm ready. Let's dive in here. Well, first off, good morning, everybody. Thank you so much for joining us. We appreciate it. So we're here for this month's installment of our breakfast briefs, which, like everything else in the world, look a little different right now. But we're going to dive in and cover a bunch of material today. So for those of you who aren't familiar with us, or even those of you who are, Lavelle Law is a full service law firm with offices in both Schaumburg and Chicago. Our attorneys focus their practice groups and their practice areas on their particular group, which really allows us to be experts in our particular field. We focus day in and day out on the same type of law. So our attorneys practice in specific areas ranging from anywhere from litigation and family law all the way to, state and federal tax, corporate work, transactional work. We really cover a wide range of legal areas. And as I said, we really do focus in, each attorney focuses in on their particular area, which allows us to really be skilled and focused on what we do. So I personally am the partner in charge of Lavelle Law's estate planning and estate administration group. So we handle all facets of estate planning and the estate administration on the back end. So preparing the documents as well as handling the administration and or probate, all of those issues. So joining me today are two of my colleagues who also practice exclusively in this area along with me, Ryan Gardner and Brian Warens. And we will be covering just a wide range of topics today. So you'll see we've got the agenda here so you can kind of see exactly what we're going to be covering. But I want to circle back on what Ryan said in that our goal today is for this to be a useful and interactive program. We want to address questions. We want to focus on the things that are important to you. So with that said, please, as Ryan said, don't hesitate to use the chat or Q&A functions at the bottom of your screen, and we will do our best to address those questions in a timely way. So with all that said, really what we're going to cover today, as I said earlier, it's pretty dense. We've got a lot of ground to cover. So we're going to start with an overview of the estate planning just area. And Ryan, can you go back to the agenda? So we're going to start with an overview of estate planning, why you need it, who needs it, all of those pertinent details. We're going to move then into covering revocable trusts, which are a really important piece of the puzzle, piece of that estate planning toolkit that many, if not all people need. From there, we're going to really dive into the meat of why we're here, which is avoiding estate tax or other tax implications as much as possible. So that's really kind of the meat of what we're going to get into here today. And we've got a bunch of different strategies for that. You'll see there's annual gifting. We have irrevocable trusts, which are different than the revocable trusts we're going to cover in the beginning. Then we'll finish with a discussion of insurance, ILITs, which are irrevocable life insurance trusts, and how those can fit into the overall plan of mitigating estate tax within the context of your estate plan. And then finally, we're gonna dive into some kind of next level strategies that are a little bit more complicated, but really are extremely useful in solving potential estate tax problems, which is really, what we're focused on here. So that's kind of the big picture overview. So since you know where we're going, that'll kind of help you if you have questions or comments that you want to make. You'll see, we may be getting to them later on in the presentation. Okay. So first and foremost, like I said before, really we're just going to talk about kind of the big picture of who needs an estate plan. And really, the simple answer is everyone. Generally, when people think about an estate plan, they think about what's going to happen to my stuff when I die. Obviously, that's extremely important. It's something that we want to cover. But in addition to that, we're covering other issues as well, such as what would happen if you became incapacitated. So certainly, families with minor children, it is so incredibly important for you to have an estate plan to ensure that there is someone in place to care for your children. That is just an incredibly important aspect of all of this. Then, as you'll see, the same with parents who have children that are dependents, people who own businesses, people who own property. Another important point is, if you've got kids that are going away to college or even staying home for college in this environment, once they're over 18, they've got to get their documents in place too. So bottom line, really everybody needs a specially, particularly crafted estate plan to cover their own particular needs. Okay, so kind of touched on this a minute ago. What does a good estate plan do? Well, of course, it protects you and your family after your death. That's what people tend to think about. What's going to happen to all of my assets when I die? So certainly that's a primary goal of having this toolkit of documents in place. In addition, though, these documents can protect you during your lifetime, meaning there will be a plan in place if the documents are done correctly to provide for the management of your affairs and your finances, especially if you become incapacitated. So last kind of bullet to hit here is it's incredibly important to get these kind of plans in place if you have an ongoing business. Then you have employees, you have assets, you want to maximize the management of that business for both your family's best interest and for the interest of your employees or other people who are affiliated with your business. Okay, so the toolkit. You heard me use some of these words before. We've kind of got a suite of documents that we use and that we carefully craft based on your particular situation. So the living trust, you've probably heard of, incredibly important. Really, it's a way to avoid probate. It's also a way to make sure that the assets are properly managed, both for you and for your family after your death. A pour-over will, which we can kind of talk about later on in the presentation, but sort of there to clean up for anything that isn't in your trust at your death. Then the powers of attorney. That's when I come back to touching on incapacity. If you become incapacitated, the best way to manage that situation is to have a power of attorney for healthcare and a power of attorney for finances or property. Those are the ways that you set up a person to handle your affairs in your best interest if you are unable. So from there are a few other documents that we can use. Irrevocable trusts, there are some assignments, there are some transfers of real property, all kinds of documents, but this slide covers the basics and kind of the toolkit that we use for most clients. Okay, so as I said before, one of the biggest points we're going to hit in this presentation is talking about estate tax and avoiding it. So just as sort of a high level touch point on this, under federal law, you can pass up to 11.58 million without estate tax. So it's a pretty large exemption. Now, that said, that is subject to change. We have no way to predict what Congress is going to do about that. It's differed throughout the years, but right now it is at an all-time high. So there are a lot of opportunities for clients who are looking to do the more complicated gifting strategies that we talked about earlier.
Heather,
if
I can add one thing to that, just for everybody out there, just as little as 2008, okay, not that long ago. In 2008, the federal estate tax exemption was $2 million. So you see how far we've come in just a short amount of time. I think all of us on this panel and other practitioners nationwide do not anticipate these exemptions always being this high. I think you start to see some shift that may be coming back down, especially in a change of administration. So, although maybe these seem like unattainable numbers,
Correct.
it's not locked in stone. It's not always going to be this way. So,
Correct.
just keep that in the back of your mind as we continue. I just wanted to add that color there, Heather.
No, absolutely a great point. A great point. And you know, one that we, again, when the current legislation was passed, one of the Congress people who was involved was quoted as saying, "It's permanent for now," whatever that's supposed to mean.
Yeah.
Actually,
So,
as soon as January 1st, 2026 is when it's set to go back down to 5
correct.
million, index for inflation.
Correct. And you'll hear in a little bit that those numbers are surprisingly easy to hit because really your estate includes literally everything. Everything. Life insurance that you don't have access to. I mean, they include literally everything. So again, I don't want to take up too much of my time on this, but the other incredibly important point to know about this particular slide is that Illinois is far different than the feds. Your Illinois exemption is 4 million, hard stop. That's what you get. And if you don't properly plan for it, you lose it. So we're going to dive into some of those strategies in a bit here, but that's kind of the overview. Good thing to know. But the most important thing to take away from this slide is that these numbers are not set in stone, and they may change as soon as 2026, if not sooner.
Great. Brian, do you want to kick us off and kind of add a little bit additional color to both the federal and the Illinois, and then just kind of keep going down that path?
Yeah, absolutely. So we each have, at least as of in 2020, as the federal estate tax exemption has been indexed for inflation. We have 11.58. Each person has this available to make gifts during life and during death. But there are certain benefits to making gifts during life too. Among them, Illinois doesn't have a gift tax. Even though to a certain amount, Illinois kind of claws back some gifts that you'll make during your life, it's still going to be a better result to gift during life in some cases, particularly if you use up your estate tax exemption completely. Because when you're making gifts during life and you've run out of credit, the money that you use to pay for those taxes, gift taxes, are not themselves subject to gift tax, whereas everything that you gift during life, the money that you use to pay your estate tax, there's already been an estate tax kind of levied about it, so you're working from a smaller pool of cash. So that's kind of one thing to be aware of. Between spouses, spouses can give as much as they want to each other during life and during death, and not eat into these estate tax exemptions. So it's one of those things that kind of you can do as much of. Other things that do not use up your estate or gift tax exemption are paying tuition directly to a educational institution for a child or a grandchild, or paying medical expenses directly to a medical provider. And as we'll talk about in a little bit, as I think Ryan will get into, you also have what is known as an annual exclusion from gift tax, which is just an amount that you can give without eating into these numbers at all, and without necessarily incurring the requirement to file a gift tax return. So I'm not going to get too much into that, but we'll talk about that in a little bit. And at the federal level, we say that the exemption is portable between spouses. That means that if for whatever reason the first spouse to die doesn't use up their federal exemption, the surviving spouse can reach back and apply that unused exemption against their assets. So if they're sitting on $20 million of assets, and they themselves only have an 11.58 million exemption, they can go back and use some of their spouse's 11.58 million exemption. But there's there's one crucial thing you have to do if you want to have that available to you, which is at least file, an informational estate tax return at the first spouse's death. But, that's stuff that you'd be coached through, with your accountant and with your attorneys. So the estate tax is pretty much a flat, at the federal level, 40% on whatever you have that, exceeds your available exemption. So you can end up at, right off the bat, you're hitting the highest rate. It isn't a graduated rate, so you're just talking a flat 40%. And then, as we mentioned, the current federal state tax exemptions are going to sunset on January 1st, unless Congress does something, which they may or may not do, and depending on the administration that's in power, we're going to go back down to 5 million, but we're going to, of course, have an index for inflation, so it'll be a little bit higher than amount.
And Brian, one quick just color to that too. I have a lot of clients contacting me now in advance of the election, just based on kind of where polls are, and of course nobody can predict with certainty, but without making any political statements, when you have a change in administration, you often will see changes in the law, right? And that very well could include the tax code. And as we continue to expend a lot of money in COVID relief and trying to stimulate the economy, one place it's kind of easy for the taking would be to look at the estate tax and potentially try to generate additional revenue for the federal government by decreasing the federal estate tax exemption to increase the pool of people that could be subject to estate tax. So for some people, whether you're at 1 million or you're at 20 million or more, looking at some of these tools is going to be important as part of your overall planning to make informed, purposeful, intentional decisions for the benefit of your family. And again, nobody wants to pay tax. That's what we're here to talk about today. So Brian, keep going. I just wanted to add that little bit.
Yeah. So I think we've exhausted this slide, so we can probably move on to the next one. So the Illinois state tax exemption, very different than the federal exemption. So Illinois has been capped at $4 million for a long time now. It is not indexed for inflation. And unlike the federal exemption, it is not portable, meaning that if you don't have a mechanism in place to use it at the first spouse's death, you're not reaching back to use an unused exemption. You have to build the structure into your estate planning documents to be able to use that exemption. And the most frequent way we do that, and it's probably going to be a slide or two from now, is doing a revocable living trust. That allows us to, put in language that's going to allow us to set aside exemption, still let a surviving spouse have access to that money, but ultimately not have it included in their taxable estate.
And I want to jump in for just a second. So we had a question from Lisa. Hi, Lisa, about the Illinois exemption versus other states. And it is different. Other states are all different. So Florida in particular has no estate tax. Minnesota has a terrible one. So every state is different. But fortunately, when you get these plans in place, these documents and these plans that we structure are changeable. They can be tweaked depending on where you're living. So anyway, I wanted to interject with that answer.
And this is a bit outside the scope, but some states have something called an inheritance tax instead of an estate tax. And that's a tax, levied on the kind of, how the degree of relationship to who you're leaving assets to in relation to yourself. Some states have that instead of, what is, pretty similar to how the federal estate tax works. Illinois is, similar to how the federal estate tax works. It doesn't matter who you leave it to, it's based on an amount. And it's a graduated amount. So you can owe at, for example, if, you are like $1 million over your, $4 million Illinois exemption, you're paying potentially, over $300,000 in Illinois state tax. So even though, we started at a relatively low rate, it escalates very quickly to reach the top marginal rate. So Illinois' estate tax is so complicated. They actually have a calculator on their website, that you would plug figures into, so you can kind of see how how they get to a final number. And like we were saying a little bit earlier, Illinois doesn't have a gift tax, but it will add back or claw back some extent of your lifetime gifts that you may have made, and kind of apply the estate tax rates to that. So even though, I mean, it's still better to make in Illinois gifts during life, because there seems to be kind of an upper limit on to what extent there will be clawback, but that can get a little bit complicated, so we won't get into that too much. So I think we can move next one. Yeah. So what's included in your taxable estate? Yeah, everything. The most surprising thing to people sometimes is, the full value of the death benefit, like on a term policy. That's going to go into the total of your taxable estate.
And Brian, we have a question too about whether a decedent becomes subject to estate tax based on the state they live in, and that, I think that's pertinent in this slide, because yes, that's what happens based on where you live. And what's interesting about that relative to what's included in your estate is that out-of-state property can actually be included. If you're an Illinois resident, even if you own, a house in Michigan, there's still a portion of it that's going to be includable. So thanks for the question, Adam.
And one more quick point on that. I had a client reach out to me the other day and said, well, Ryan, we think we're probably going to relocate to Arizona sometime in the next few years. We certainly want to work with you and get our estate plan drawn up, but we're not exactly sure when. It's not an imminent move, but we know that Arizona does not have a state imposed estate tax. And I say, wonderful. It doesn't mean you shouldn't do your planning now, right? Get it done now. And to Heather's point earlier, the great news is that we know that the documents, the way we draft them, again, with intention and purpose, are flexible enough so that when you do move, you're able to change the applicable law, number one, to the state of your new residency. And number two, to Adam's question, it is all depending on what is your domicile at the time of your death. So if you have Illinois trusts, but you move to Florida, a year or two before, and you die a Florida resident with Illinois trusts, you're not taxed as if you're an Illinois resident. You're only taxed in Florida as a Florida resident, which has no state level estate tax, but you are still, remember, subject to the federal estate tax and whatever that exemption is in the year of your death. Just wanted to add that. Continue, Brian. Thank you.
Sure. And we have another question from Brian Brandt, that, most people have no idea what the gifting limits are, so they don't track their gifts. So how is their gifting amount calculated at death? So for the most part, the IRS is not paying attention to people that are going to, be gifting under these limits during their lifetimes. You still technically have an obligation to file a gift tax return if you gift more than, $15,000 per person in a particular year, and you're not otherwise, making those direct tuition, medical, charitable gifts. In my experience, I've not seen it be a huge issue. The IRS is concerned about people that are, have assets that are going to, in general, far exceed these exemptions. I don't know. Do you guys have anything to add to that?
Well, I mean, like anything else, some of it just depends on an audit. If whether
you get lucky or not. Yeah,
that's right. And but for larger gifts, you absolutely want to file a gift tax return, because if for no other reason than that gets the statute of limitations running for when the IRS can come back at you and say that this was an improperly valued gift or you didn't provide adequate disclosure. So there are reasons that you want to file a gift tax return, just to get that clock running, if for no other reason.
Yeah, to put the IRS in notice and, lock in a lower value of a gift, because obviously the IRS is going to try to go for the maximum value they can to increase the value of your taxable estate at death if they can. So yeah, good question. So common methods to mitigate estate tax. We do it by planning around using, someone's particular exemption through use of what we call credit shelter trusts in a revocable trust. And I'll talk about that in just a moment. You make annual exclusion gifts. So this is that, $15,000 that you can gift to as many, per person to as many people as you want without eating into those lifetime exemption amounts, that 11.58 million at the federal level. You can give charitable gifts, those to 501c3 organizations that, will not be something that reduces your estate tax exemption. We've had people even just, move to a different state and divest themselves of Illinois assets. And, you move down to Florida, you own everything in Florida, you're not worried about estate tax in other states. And we also will use irrevocable trusts for certain purposes, like irrevocable life insurance trust, ILITs. If those are set up the right way and the proper, steps are followed, the entire death benefit, of your life insurance can be excluded from your taxable estate. Ryan will talk about that in a little bit. So a revocable living trust. This is the backbone trust of a lot of estate plans. It's an entity that you create during your life and it continues on, in existence after your death. If you become incapacitated, a successor trustee uses assets for your benefit. Upon your death, then the successor trustee, manages the assets for the benefit of whoever you name as your after-death beneficiaries. And it's seamless. A properly funded trust is going to completely bypass probate. And by properly funded, we mean either titling assets into the name of the trust during your life or naming your trust as a pay-on-death beneficiary on an account. You, for example, for life insurance, if you may potentially name or your spouse as your primary beneficiary and your revocable living trust as the contingent beneficiary. And, that way we have a non-probate way of passing assets into a trust. Assets are part of probate, if they are just in your individual name and they have no, pay-on-death beneficiaries attached to it. A common one that I have seen is maybe a checking account that doesn't typically let you name a beneficiary and, may have $120,000 in it. Congratulations, you have a probate asset and it's going to have to go through probate, to get, to where it's your trust, for example, even if you have an otherwise properly funded trust. A revocable trust does not protect your assets from creditors. Creditors can reach your assets to the same extent you can. So, if you are completely in control, you can take assets out for whatever purpose. It's not a shielded entity. So one of the other big advantages other than estate tax planning, that you can do with revocable trust is, put in provisions talking about to what extent and at what ages, children or other beneficiaries would get access to assets. You can say, they're going to get, one half of what I want to leave to them at age 25. They're going to get another half at 30. You can make it, contingent on whether they get a bachelor's degree. They get a chunk then, and then another chunk at 25. But if they don't have a bachelor's degree, it's 25 and 30. There's a lot of ways that a trust allows you to, continue to provide for the responsible management of assets until your beneficiaries are old enough to receive them. And revocable trusts after your death do have some form of creditor protection for your beneficiaries. If the trustee is able to use assets for their benefit and the trust doesn't, require a beneficiary to withdraw assets, then, the assets that remain in the trust are not necessarily subject to a creditor claim.
We have a quick question. I just want to, I don't want to derail us, but we have a question about a deferred compensation arrangement with a former employer and whether that would be includable in the value of a taxable estate. The answer is yes. Even something that has a payout to a subsequent beneficiary over time, kind of as we talked about before, going back to that idea that everything is includable in your taxable estate, even though there's a designated beneficiary who's going to receive the payout, it will be includable in the decedent's taxable estate. So anyway, sorry, I don't want to derail us. I just didn't want to miss that question.
No, of course. So one of the two ways that we plan around using up someone's estate tax exemption in a revocable trust is what is known as a disclaimer trust. So this is not necessarily saying that, assets are going to mandatorily go into a trust that uses up your estate tax exemption. It's saying that we're going to make that decision upon the death of the first spouse to go. So that means that, if two spouses combined have, a $6 million estate, we're going to say, maybe each trust has $3 million in it. The survivor spouse is going to make the decision to say, hey, I'm not going to take all this money. I might only take, 1 million of it because it's going to put me at my Illinois exemption. And then I'm going to leave the other 2 million behind in the deceased spouse's trust, in what we sometimes call a family trust in our documents, where they have limited access, but importantly, they still do have access. And, the money that's left behind is not going to be includable in their taxable estate. And then we can go to the next one quick, Ryan. So the credit shelter trust is a way of, in some cases, using up the estate tax exemption while making sure that, it's kind of what I would say the mandatory funding of the family trust. We're saying that $4 million is going to go into, a family trust. And then, anything over that amount is going to go into a marital trust, which defers the payment of tax, until the death of the second spouse to die. So similar to a disclaimer trust, we're still going to have access to this money, but it's limited. It's things like mandatory income, principles available for health, living expenses, education, things of that nature. That's how it's also a structure that we sometimes use in second marriage situations, with a wealthier spouse that still wants to, allow their survivor spouse to have significant benefit of their assets, but not outright ownership.
So, and that's I would say is an important point, is to some extent, yes, in order to take advantage of this tax benefit, this large tax benefit, the IRS makes you jump through a few hoops. So the surviving spouse is absolutely able to use the money as necessary, but there are just some limitations on it, it's a balancing of interests. So, in order to get the benefit of sheltering the money in the credit shelter or the disclaimer trust from estate tax indefinitely, forever. Once it's in the credit shelter trust, it's never subject to estate tax, which is a huge upside, huge from a tax standpoint, but you've just got to jump through a few hoops to make that happen.
Mm-hmm. And it is so flexible, right? I mean, there's that IRS standard that they allow surviving spouses to utilize, this we call HEMS, health, education, maintenance, and support. that right there, you can kind of, dream up as many different, permissible expenditures as you can think of, right? I mean, certainly you're not buying a Bentley if you've never owned a high-end luxury automobile in the past. That's probably outside the scope. But, if you're used to having a new car every few years, that's covered. You have a lease payment, that can be covered. Mortgage payments, that can be covered. So why not utilize that pool of assets for your living expenses so that you can, again, shelter the rest of your assets from estate tax and other creative ways? So again, we want it to appear, and it should be clear that it is still available and controllable by the surviving spouse. We just have to, be smart and tactical in the way we do it.
That's it.
And one last thing I just want to add, if I can, is the appreciation of those assets inside these disclaimer credit shelter trust occurs outside of your estate. So to the extent that you're not dipping into these assets and you have other assets available, for your health, your care, your living expenses, that's that much more that's going to pass estate tax free, to your children and other beneficiaries.
Wonderful. Brian, thank you as always. By the way, Brian's one of our sharpest tax minds at our firm. He's been doing IRS estate tax returns, at least guiding trustees on that. He actually runs a lot of our trust administration, estate administration work in our group, and we're ever grateful for him. I know we're a little short on time, so I'm going to try to burn through this, guys, but bear with me, okay? When Brian mentioned this and Heather mentioned this earlier, which is this idea of annual gifting. Okay, this is one of my favorite tools that some of my clients like to utilize, and it's the fact that every year an individual can give up to 15,000, and that number was 10,000 probably eight or so years ago. It's up again now to 15,000, even going into 2020, or as we're here in 2020. So 15,000 a year to as many people as you want. So if you're a single person and you have 10 nieces and nephews and brothers and sisters that you want to include, you can actually tax-free give 150,000 of assets every year to, again, the idea is to try to depreciate the assets within your taxable estate. That's, of course, if somebody's got 300,000 in their bank account, it may not be worth it to give away half your money in 1 year, right? This is really kind of more for some of our clients that have amassed a decent amount of wealth or are looking for additional strategies to, engage with their other family members and help them on their kind of their next chapter of their life. If you're married, you and your spouse can actually give 30,000 to as many people as you want, right? 30,000 per person. So that same 10 people would actually be able to do 300,000 a year in gifting. So what kind of assets can we give? Of course, we can give cash. We can give stocks and bonds. That's kind of a nice tool because if I give Apple stock now to my nephew, the odds of that, going up in value over the next whatever number of years as he's a 6-year-old, right? That's pretty good. Or I could give, S&P mutual fund shares, whatever you can kind of dream up there that would have appreciation outside of your estate, to Brian's point from earlier. Right, so there's some value there. We can do life insurance premiums. That will make sense as I talk a little bit more about the ILIT, or the Irrevocable Life Insurance Trust, that so many of our clients love, and we'll talk more about that. 529 accounts, you want to help different people fund their education while they're young. You can use annual exclusion amounts to gift into those 529 plans. Closely held business interests, this is one a lot of our clients like as well, because you can still retain a lot of control, but give away assets that also will appreciate in value over time. We'll talk more about that, and there's discounts we can take. I nerd out on this stuff, but I think it's really, really a powerful tool. But really anything can be gifted up to the tax exempt value, right? So when we're gifting, we have to decide how we want to gift. Am I going to say, hey, my best friend Heather Walser, Brian Warens, I want to make sure that I give them a little something. Thank you for being such a great friend. I'm just going to give each of you 15,000, or my wife and I will give you 30,000 each in cash or in Apple stock or in whatever it may be. Certainly I can do that, but there is a lot of benefit when you're gifting to people via irrevocable trusts, held in trust for their benefit, because then I can still control their access, the way that they can enjoy those assets, it can be flexible, but it's also not, hey, I'm going to give you X amount of dollars every year and now you're going to run to Rivers Casino and blow it all, right? So there's kind of a give and take, and every situation is going to be different. So looking at the family dynamics, looking at the assets we want to gift, looking at the kind of additional structures that may be beneficial there. But one big point is that it needs to be what we call a present interest gift. If I give Heather Walser $15,000 in cash tomorrow as my annual exclusion gift, certainly she has an interest in the present, right? She can go and spend that or save that or do whatever she wants with it. That's enjoying the asset immediately. Or if we don't have that, like I gift $15,000 into an irrevocable trust that I set up for my nephew or for my son, well, that child or nephew or whoever you want to gift to, even if they're an adult, but you say, hey, I want to have some control over it, they have to have the ability to withdraw it in order to make it that present interest to qualify for the annual exclusion gift that we're talking about. If you give it to an irrevocable trust and that person does not have the technical ability to withdraw, we don't think they actually will, but they have to have the right. Okay, by having that right, we convert it to a present interest gift. And most of the time what it is it's what we call a crummy notice. It's not crummy because it's poor or it's not fun. That's an old tax case that defined this issue of the present interest gift. So we just write a notice to them and to the beneficiary. We say, hey, your dad contributed $15,000 into the trust for you. You have 30 days or 60 days to withdraw it. If you don't withdraw it, that withdrawal right lapses, which is actually what ends up happening almost invariably every single time.
I was just going to jump in and say that in my entire career, which is longer than I probably would care to admit, I've never seen it happen. I've never seen a beneficiary say, oh, you gifted, $20,000 into this irrevocable trust for me. I'm going to take it. And the reason is because then it's very easy for Ryan Gardner, who gave Heather Walser 20 grand in an irrevocable trust. If he sees me pull it out when his purpose was to keep it in trust, he's going to say, well, live and learn. I'm not doing that again. So in many of these cases, there's an ongoing gifting strategy in place. So the beneficiary, if he or she knows what's good for him or her, is going to say, great, I have that right. I'm going to decline to use it and you can keep giving me money. So
that's right.
It works. I mean, it sounds a little scary, but it absolutely works.
That's a great point, Heather. So I appreciate you adding that color. So what are some of the benefits of when we do this annual gifting into an irrevocable trust? Well, we can still control the beneficiary's access to the trust terms or via the trust terms, right? So, I can say how Heather Walser or how my nephew or how my son can enjoy those assets. I can be restrictive. I can be very generous. It's up to me. So I still have the control, even though I'm giving away the money to an entity, this irrevocable trust over which I no longer have control. So, it's nice because we have a little delayed gratification. This is not just I'm going to give my assets away immediately and now people can go ahead and spend them frivolously. There is that delay we can build in. A common one I see is when the child turns or when the beneficiary turns 30, they can take a third. When they turn 35, they can take half of what's left. When they turn 40, they can take the rest. Just as an example. Sometimes we build it to be dynastic in nature, right? So that's just a fancy way of saying we want to provide for future generations and what we call generation skipping. That's kind of outside the scope here. That we could do a whole hour plus on just generation skipping, transfers and taxation and kind of what that looks like. But basically that's a really nice way of saying, not only do I want to give to my children, but I want to give to my children's children and their children and onward, right? One thing that's nice is that when I give those assets to that irrevocable trust, they are out of my estate. Now they're no longer subject to my estate tax when I die. They're outside. And because they're outside of my estate, if I get sued, or I have a car accident, or I have a bankruptcy, or I've got a ex-spouse or something going on, those assets are protected from me, the giver, from my creditors, ex-spouses, bankruptcies, things like that. And the other benefit here is that not only, to Brian's point, remember, revocable trusts do not give us that asset protection for ourselves, but irrevocable trusts absolutely do. And not only will it protect from our creditors, but also from those beneficiaries' creditors as well, okay? As you may imagine, right, there's many different types of irrevocable trusts: the ILIT, the IDGIT, the CUPRIT, the CLAT, the CLUT, the SLAT, the BDIT. We're such nerds, we have to come up with, all these acronyms to keep us, excited about different types of irrevocable trusts. But, here's the idea, right, is that it could be for individuals, like family members or friends or anybody that you want, or it could be for a charity. And there's pros and cons on both sides. If you're charitably inclined, you can do it that way. Actually reserve income for yourself. You can give away $1 million into a charitable retained annuity trust, and you will retain an annuitized payment every year for the term that you set. But at your death or at the end of that term, the rest of the money goes to the charity. But you've gotten A, that money outside of your estate, B, you still retained an income stream. So there's some benefits to doing it when you are charitably inclined, right? Or if it's just for the benefit of different family members, certainly there's all different mechanisms and different trusts we can use, and we'd love to explore those with you if that's of interest. What are some key features when we talk about irrevocable, or some people say irrevocable trusts? Well, it's unamendable. All those benefits, hey, get it, hide it from your creditors. It's outside of my estate. You can't tax it. Well, you have to give up a lot to get that right? So you have to give up the ability to change the language of the trust. It's unamendable at that point. There's a backdoor way around that. We'll get into that, what we call our trust protector. You have to relinquish what we call incidents of ownership, so ability to control, to direct, to enjoy, and a lot of the time. All those different things that we would enjoy just owning our own bank accounts, we have to give up that right, but we get so much back in return, right? Someone else is usually the trustee. We don't want the person who's creating the trust to still have control or still be able to direct, so we want somebody else, whether it's an individual or a corporate institution. I know that there's some great financial advisors on this call who have wonderful trust groups, right? There's different wealth management companies that will do it. There's different banks that will do it, and it's a complex process. So sometimes it's really beneficial to bring in that strategy from a corporate perspective to help make sure things are done right. Because that would be about the worst case scenario where you name your brother or your uncle or your best friend to be the trustee, and for all intents and purposes, you think they're doing the right thing, but they haven't given crummy notices, or they haven't been maintaining a separate bank account, or they haven't been giving trust accountings to the beneficiaries. Any one of those things could result in breach of fiduciary duty for them, but it could result in these assets coming back into your estate, which is exactly what we're trying to avoid. We could have had 10 years of gifting, $3 million over 10 years between all these different people, and all of a sudden that $3 million comes back because the person you named to do it didn't do what they were supposed to do. So,
right. And I think, let me jump in for just a second here, Ryan. I think you keep hearing this theme throughout, that to get these tax benefits, there are just hoops you have to jump through. It is what it is. It's not, it's worth the trade-off of the, significant tax benefit of getting these assets out of your estate for both creditors and for estate tax purposes. So, and I see we're kind of starting to get a little tight on time, and I want to make sure we get through everything today. So I just wanted to interject and say, the big theme in all of these strategies that we guide our clients through is that, there's some hoops you have to jump through to make them work, but in the end, they're absolutely worth it in keeping the money out of the hands of the Illinois Department of Revenue or the IRS.
Yes, thank you. I do tend to get passionate about this stuff, so I will move a little quicker on this. But certainly, we're going to avoid estate tax, and assets in that irrevocable trust will avoid probate court. Right, one of the big tails wagging the dog for a lot of my clients. Let's continue on here. So, irrevocable trust, we have a grantor who's the creator. You can't change it. You can't regain assets. Trustee is our manager. Right, they're going to be. It's a family member, a friend. I tend to recommend corporate trustees. I think that's a really powerful tool. The powers for that trustee are defined in the instrument. You can customize those. You can, kind of dictate what you want when you create the trust on the front end. We have the beneficiary. That's the person who gets to enjoy the assets, whether that's a family member, a charity, or if it's a grantor because we're splitting it between a charitable trust and the original creator for income. And the access is going to be defined in the instrument. One of my favorite tools that we like to use here at Lavelle Law in our group is the trust protector. Unfortunately, I see a lot of firms not utilizing this. This is something I think one of the many value propositions we bring to the table and differentiates us is what we call this trust protector. It's checks and balances on the trustee, number one. That's always good to have somebody else making sure things are going the right way. And it can be a family member, a friend, an attorney, somebody that you trust. But one of the things I like about it is although this trust cannot be changed by the person who created it, the grantor, it could be changed by the trust protector based on the different abilities that you give to that trust protector. So kind of like I said, that backdoor way to have some amendments to an unamendable trust. Okay. ILETs, one of my favorite tools. I use this with a lot of my clients, even ones that are not multi-millionaires, but those that have a lot of death benefit if they were to die. I mean, me personally, I'm at 3 million in death benefit. So if I die tomorrow, 3 million is going to my wife. If I have a bunch of other assets that are out there and I'm over 4 million without a trust, I'm going to be in a tough spot. My wife's going to be in a tough spot from an estate tax perspective, not utilizing and not doing the right things. Of course, that's not me, right? I'd be a bad attorney if I wasn't wearing the shoes that I'm selling to my clients. But here's the idea, right? Is the irrevocable life insurance trust is created for the sole purpose of holding life insurance policies and proceeds so that upon your death, those proceeds stay outside of your estate. The owner and the beneficiary become the ILET. Usually you'd make your spouse the trustee, or you'd make a best friend or a corporation the trustee. But what I would do is I either transfer my existing policies. Even better, we work with you before you obtain that policy or a new policy, and we buy it in the name of the ILET. It's never in your estate. It's always outside. If we transfer it, after we already own it. Now we see Ryan, we see Heather, we see Brian, help me with an ILET. That's okay, but there's a 3-year survivorship rule. So you have to live 3 more years when you just transfer it for no value. One way around that is to do a kind of a more involved transfer by sale. We're doing a few of those actually for clients right now. It's a really powerful tool to avoid that 3-year rule. Without an ILET, this is the key, guys. I want you all to just hear me loud and clear on this. Those death benefits that you have on the term policy, on the cash value policy, permanent, variable, work policies, I don't care what it is. When you're the owner and it pays out to whoever you want as a beneficiary, that is taxable inside of your estate. When we have it in an ILET, it's outside of your estate. Okay? What about this irrevocable gifting trust that we do? Well, we tend to like the idea of what this IDGIT is. So intentionally defective grantor trusts. We could do a whole nother, presentation just on the strategy there. But the idea is to create irrevocable trust to receive different benefits for family members, especially important when we have closely held interests and the key here, again, a super, pardon me, I think it's a really creative way of doing gifting, not just ILETs, not just 529s or anything else, but when you have amassed some decent wealth, or you think in the future, I'm going to continue to, generate additional wealth and I need to do some strategies now. I'm afraid that exemption's coming down. I've got a lot of life to live. Well, let's take some discounts, right? So we could actually create a family partnership or a family limited liability company. I'll just call it an FLP for short, family limited partnership, where this partnership is going to own different assets. It could own real estate. It could just own simple brokerage accounts. We don't have to actually have a warehouse and tool making and all the different inventory to have a business for purposes of estate tax planning. So the idea is you create this FLP, you have an agreement that's going to define management, transfer of interest, retention and control. We're going to get valuations done. We're going to have discounting on those interests because the IRS lets us do that. There's a difference between having the ability to control versus, hey, I can't control, I'm just a passive owner here, right? Or the ability to vote, the ability to sell those interests of that FLP on the open market. Certainly we don't have that, and we would want to make sure that we have that defined in the agreement. One of the discounts we can take is what we call lack of marketability discount. Right. So what does that mean? Well, that means that I can't sell it. Or if my dad has gifted to me via an FLP into either my irrevocable trust or just to me individually, the partnership agreement says I'm a minority owner and I cannot sell my interests to anybody that I want. In fact, I have to sell it back to the partnership and I have to get approval from the manager. And that right there is going to tell the IRS that my minority or lack of marketability interest is worth less than the one retained by my dad or for my grandfather or whoever, right? So that's just something to keep in mind. Lack of control or minority discount. If I can't control this, then my interest again is worth less than the one retained by the person who gave me that interest, right? The dad has 99% and he gifts 1% to his son. Well, that 1% is clearly worth less than 99% just on its face, but also we're saying if you're less than a 49% owner, you don't get to make managerial decisions. You don't get to vote on how the company is going to be run or what investments we're going to make. You're kind of just on the outside looking in, although you're included in the family limited partnership. But again, the IRS says that the value of those interests are worth less because I don't have the ability to control, and we can discount. I guess that's the point I'm trying to make. So instead of saying that I'm going to give $30,000, me and my wife are going to give $30,000 to our son of our family limited partnership that we created with Heather and Brian that only holds my Charles Schwab brokerage account, okay? That FLP interest that I gift to my son's irrevocable trust is now outside of my estate. Its appreciation is going to happen outside of my estate, so there's tax savings there as well. And on top of that, the interest that I gave is so small and can't be controlled that we have the ability to take discounts. So one of my favorite things, instead of giving $30,000, maybe we can give $35,000 or $38,000, but with the discount and the valuation firm and the CPA and the attorney all working together, we can say that, oh, you know what? On paper, that gift actually only worth $29,958.62. Just under our annual exclusion, but we're giving away actually more because of the discounts. It's one of my favorite tools and something that you could see go away in a change of administration. President Obama wanted to do away with it and he didn't. Obviously, President Trump and kind of where he's aligned, he's not going to do away with this as long as he's a president, is a fair assumption. But if we do have a change in administration come 2020, don't be surprised to see some of these tools that we can utilize now go away. So there is some urgency to kind of look at some of these strategies, see if it's important to you or well to be utilized by you and beneficial, right? So that's the idea. There's a whole slide here, and we'll send this around to anybody that would like it. You can have our slide deck without question, but this giving of the discounts, you can see there's a whole strategy on how it works. And I know we're here at 9:30, so I want to let Heather wrap up. Certainly we're here to help you guys, coach you through, even just have a free phone call. Go through this again, see if it makes sense for you. Let's talk.
Yeah, agreed. Thanks so much, Ryan. And another one of the facets of that discounted gifting he's talking about also kind of again ties back into these hoops that we have to jump through with the IRS. But with those gifts to a family limited partnership or a family LLC, any of these discounted gifts, another huge benefit is you get to maintain control. So I just wanted to point that out. All these things look so complex and difficult, but it's a great way to get assets out of your estate and still maintain some control over them. It's kind of having your cake and eating it too, so to speak. So Again, thank you all so much for joining us. We've left aside some time for questions, although we've tried to be responsive, in real time. But please, by all means, if anyone has a question they'd like us to address now. I see one of the questions we have is whether we can share the recording, and yes, this recording will be posted to our website, and I believe you will also get an email notification once it's live. Not live, but once it's available on the website, you will be able to watch it again. Yes, absolutely.
And, absolutely can share the slide deck, and, feel free to send it around to anybody that may have missed this call today and you think could benefit from just a little additional education. That's one of the things that we pride ourselves on here at Lavelle Law is we're educators. We're not just, sitting in the back room drafting and just working through clients quickly. We really want to have strong relationships with our clients because we are going to be lifetime advisors for you, right? We take that very, very seriously, and it's something that we pride ourselves on, right? And again, when you look at differentiators, because you can find different people to draft wills and trusts, one thing I would just say is make sure you work with somebody that truly does focus in this niche area. You'll always find somebody that says, oh, I can draft your will, I can draft your trust, and they may do 15 other things. Just be a little wary about that. I'm not telling you what to do, but just be aware of that and do your due diligence, get the education to make a truly informed decision. As you can tell, we're all very passionate about this. I think we could have had a 4-hour presentation about this and really given you a lot of more examples, but I think hopefully this gave you enough to really, kind of wet your beak on it and see if some of these things may resonate a little bit, whether it's now or in the future. We're here absolutely to coach you through that. We love what we do, and we love the opportunity to help you and your family without question.
Okay, well, again, thank you all so much for joining us. You have all of our contact information here. As Ryan alluded to, we start the process always with a free initial consultation. So if you have any questions or want to discuss any of these issues, please don't hesitate. You've got all of our contact information, and we would absolutely love to hear from you.
Yes. Thank you all for attending. Absolutely. Have a great rest of the day. Stay safe out there. And we're here whenever and however you need us.